Nick, very good to see you. Big news. High earners age 50 plus are about to lose a major tax break. Starting next year, workers age 50 and older who earn more than $145,000 will lose a key tax break for their retirement savings. What's new?
So, just right when they start talking about taxes going down and everything, and everybody's starting to not talk about taxes. What's funny is in like 2020, 21, 22, 23, everybody was like, taxes, taxes, taxes. Then the topic moved to inflation. And now I think the topic is like Nvidia, Bitcoin, and gold. It's like, it's weird what is actually on people's minds and how that changes over time. And,
Right.
and so, right in the middle of it, is this one here, where the IRS has these new rules on catch up contributions on 401ks, basically saying that if you make over $145,000, I pulled off a sheet so I didn't mess this one up because I had to look at this one just to make sure that I saw this right because it didn't seem right to me. But yes, if you earn over $145,000, the old tax way was for catch up contributions. And what that means is if in 401ks, your standard contribution, you can put up to $23,000 in it. And then if you were over 50 years old, you could actually do a catch-up contribution of another $7,500. So you could put that on top of it, and that's like $30,500 that you could deduct on your taxes today, which sounded great. Well, now if you make over $145,000, what they're saying is that catch-up contribution, that $7,500 of catch-up contribution, can no longer be deducted. It's actually going to go into the after-tax Roth side
Right.
Of that account. So no deduction on that, which is going to stink now because less deduction now means more taxes now. But the upshoot is of that, there's more tax-free money that it's actually going to force people into savings. So it could
Right.
actually not be awful.
Right. Let's do a deeper dive on that because, as you're explaining, of course, before it was workers could reduce their taxable income with pre tax catch up
Right.
contributions. So, how will the switch to after tax Roth contributions affect take home pay and future withdrawals?
So let's say that you were saving 7,500 catch up.
Okay.
If you're in a 25% tax bracket, that puts you right at about $2,000 of tax savings by doing the catch up. So you put 7,500 in, it's another deduction, or you get to deduct that off. So that's in essence like $2,000 in tax savings. So you lose that on the front end. But what's actually happening is it's saving that 7,500 catch up in a tax-free way. So it's giving you tax-free flexibility on the back end, although on the front end, it's kind of a bigger pain. But the thing is, look at it. Do we want to pay taxes now at what I would say are discounts, or taxes later at who knows what it's going to be? And I think if we really think about that in our hearts, we know taxes are going up in the future. And so that's why I said, this sounds bad, but it might not be awful.
Right. And so again, let's get even deeper because I think, Nick, what you are pointing to here is the $1 million question, right? How do we determine if we should be contributing to tax deferred or tax-free after tax accounts anyway?
So look at what tax buckets that you have your money in. So if we were to say, and I love this example here of a teeter-totter. So the top side is a traditional pre-tax IRA 401k. You would use that strategy if you thought, right now I'm working and I'm making an incredible amount of money and my taxes are so much higher now than they ever will be in the future. And when I get to retirement, my taxes are going to be less in retirement. Well, then you would probably say maybe traditional might be the way to go because I get the deduction today to help offset my big taxes now. And later on in retirement, I'm not going to have much in taxes. So what difference does it make? The Roth is what you would do if you looked at it and said, you know what, I don't know what the future of taxes is going to be. And it's probably going to be higher. And I've talked to my mom and dad about what they're dealing with. And my mom and dad at turkey dinner are talking about how tax rates are actually going higher than that for themselves. And they're telling me, you better have more tax-free money. And so if you're hearing that story, then the Roth option might be the better one to go. So it just depends on where you think tax rates are going to be going in the future. And from what I can tell you from most of the people that we work with, their tax chart looks like this. They get to retirement, and then ever so slightly every year it keeps going higher and higher and higher and higher and higher and higher and higher. And they end up with more taxes later on in retirement than they did when they first retired. Versus what I like to see, which is get the taxes out of the way so that you have a retirement that's lower in taxes as time goes on. Another way to look at this is if I was a farmer, what do you want to pay taxes on? And I'll ask you this, Aaron. If you were a farmer, I know you're not, but if you were a farmer, where did you pull that one from?
I'm
Oh
always
my
at the
gosh.
ready, Nick. I'm always at the ready.
Your finger is
I
like
knew
right
where you
there.
were going.
Oh my gosh, that's like perfect. Well, what do you want to pay taxes on? The seed or that big tree,
The seed.
Later on.
Yeah.
And so I'd rather pay taxes on the 10-cent seed versus the, $100 harvest. So you just don't want to be held hostage by one tax bucket in retirement.
Right.
You want different buckets of money. You want tax-free money in there too, so that if the Congress does what the Congress does, it doesn't affect you so much because, hey,
Right.
you know what? I mean, think about it this way. Let's say you had to take out a $15,000 withdrawal. If all you had is pre-tax money, then that $15,000 withdrawal is going to get taxed as ordinary income. But if you have a Roth, tax-free money, and you got to take out that $15,000 withdrawal and you have a Roth, well, then you can take out that money tax-free and it doesn't affect you on your taxes this year. Mm-hmm. It's a nice ace up your sleeve.
Right. But Nick, let's say that we have somebody who is just married to that tax deduction. They love it. Would you recommend other strategies like health savings accounts or other tax advantaged accounts to make up for that lost deduction?
Well, I love what you just said there with health savings accounts. There's triple tax advantages with health savings accounts. And what happens is, look at it as a bucket of money that you're using for health-related expenses. You can put in up to $8,550 as a family, plus another $1,000 for catch-up if you're old enough. That's $9,550 you could put in this thing every year. When you put that contribution in, it's tax deductible, meaning you deduct that on your taxes. That's beautiful. Then it grows tax-free. And then if you take it out for a qualifying medical expense, which there's tons of them, it's a tax-free withdrawal. I mean, I'll have people that have said, hey, my eye doctor, I have to get glasses. I take money out of my HSA to pay for it. So it's like this bucket of money for an expense that we know we're going to have. And so I love an HSA. It's a great tax advantage that a lot of people don't use. I'd probably say 15% of the people that I ask say that they have a health savings account. And most of the ones, even though at that 15%, it's accidental. It's almost like, well, my company said I had to have it, so that's why I have it. Well, do you know the advantages of it? No, not really. So it's still new. I don't think many people have been using it or know how to use that. So that's probably something to consider there. And then another thing I wouldn't throw away is a Roth conversion. So a Roth conversion is where you take money that you have already in an IRA, already pre-tax. You pay the taxes on it right now so that it can become a tax-free bucket later. Now that stinks because whenever you move money, you got to pay those taxes up front. That's the part that stinks. But once that money moves over, it's tax-free. There's no minimum distributions on that money. It can pass on tax-free to your beneficiaries. It can be a tax-free income source for you. And I would tell people, if they think that the future of taxes is going to be lower for them, just do a Google search for a guy named David M. Walker. David M. Walker. He's the former Comptroller General of the United States government. He's basically a guy who audits the government. And I've mentioned his name a few times on other interviews too. And so I bring that up because he says that the debt that we have from Social Security, Medicare, Medicaid, and the interest on the debt is so high that tax rates are going to have to double at some point in the future just to pay the bill. So if he's saying that, let's say he's off by 50% and taxes have to go up 25% from where they're at, then I would much rather have a lot of tax-free money that I can get to later on, if that makes sense. And that's why we say you don't retire without a plan. You got to pay attention to how your retirement savings is going to be taxed in retirement. Congress has just moved a tax goalpost. They're looking at this usdebtclock.org, and what's funny about this is something that I use at our live events. I will have this up there running during our live events
Ooh,
just
why
to
are you
show
so
people.
mean, Nick? That gives me anxiety.
It does give anxiety, but the thing is we all have to be aware. It doesn't mean stop playing the game. It just means you work with a coach and you change the playbook. We can't get rid of the facts of that is the number. The debt is going up, but what we can do is we can use that to give us an important data point that the U.S. debt is at 38 plus trillion. It's not going down. It's not going away. It's not going to disappear. What will happen is we'll have cuts in benefits. Social Security will likely be going down. Expenses will be going up. Taxes are going to be going up. I would almost use this as a precursor. Look at this as, you know what? I have a 7 to 10 year heads up that we have a hurricane coming
Mm-hmm.
rather than a hurricane's coming in 7 hours. You have years to plan for this. Take the opportunity.
Right. Well, clearly, proactive planning is key. If somebody would like to learn more about how these upcoming changes will affect them, because there's a lot of changes to taxes, as you mentioned at the very beginning. Nick, what's the best way to get a hold of you?
Well, what they can do is they can go to a website called diffusethetaxbomb.com and they can get a copy of our book. Another way they can do it too is they can go to our website, group10financial.com, and they can get a copy of the book Diffuse, the 7 Steps to Saving Your IRA and 401k from the Ticking Tax Time Bomb. We're going to go into strategies in that book that are pertinent to what we're talking about here. So I would say that is a great first point. We've also put a toolkit together for this. We believe in this so much that we put a toolkit together to help you understand now the ramifications of taxes, the opportunities that are available, so that you can get taxes taken care of now while there's time versus later when there's no time. So I would say those are the 2 best resources that people can use to at least move the dial and to get educated on what's happening and increase your financial intelligence.
Yeah, the time is now. Nick, thank you so much. I appreciate it.
Great being with you.